All right, let's just dive right into this explainer. If you've ever felt completely overwhelmed staring at a chaotic, cluttered chart, you are definitely in the right place. Today, we're going to explore how stripping away all those lagging indicators can absolutely transform your trading consistency. We're talking about removing the noise, focusing 100% on pure price action, and challenging you to totally rethink how you engage with the markets.
So, here is our roadmap for today. We'll start by tackling the indicator trap, then move into the essentials of naked trading, figure out how to spot high-impact zones, and nail down our candlestick triggers. After that, we'll cover the ultimate shield, risk management, before I hit you with a one-week challenge designed to really test your discipline.
Okay, Section 1. The indicator trap, why more isn't better.
Seriously, so many beginner and even intermediate retail traders fall into this painful trap. You slap on an RSI, maybe a MACD, toss in 3 moving averages for good measure, and suddenly your chart looks like a bowl of spaghetti. You can barely even see the actual price. And the kicker? When you're trading highly volatile assets, think Bitcoin or gold, relying on these math-based formulas usually just creates complete confusion. If an indicator tells you to buy a massive gold breakout, it's relying on past data, which means it's probably lagging by 10 candles and the move is already over. Price action trading, on the other hand, is leading. It's clean. It keeps you locked into the real-time tug-of-war between buyers and sellers so you can read the market sentiment immediately without that dreaded analysis paralysis.
Which brings us nicely to Section 2, Naked Trading Essentials, stripping the chart. So what exactly is naked trading? Well, it's pretty much what it sounds like. You are literally trading without technical indicators. Instead of relying on crutches, you're reading raw price action, candlestick patterns, and the actual market structure. By trading in all that lag for pure clarity, you build a real, gut-level market intuition. You stop being a passive passenger blindly following a signal that's 10 bars too late, and you finally start driving your own trading decisions based on raw, real-time data.
Now, get a load of this number. What makes 89.58% so wild is the history behind it. When people have backtested simple, no-indicator reversal strategies over a massive 14 to 16-year window, they've seen profitability rates hit up to 89.58%. So, we aren't just guessing here. We're looking at repeatable patterns driven by basic human psychology that have literally worked for decades.
All right, let's move to Section 3, Finding High-Impact Zones, the Market Battlegrounds.
Since we've ditched the indicators, it's totally on us to find where the big liquidity is hiding. First rule, treat support and resistance as zones, not razor-thin lines. The market is messy. It probes, it tests, it almost never turns on an exact dime. You'll want to scan the daily or 4-hour charts just to filter out the intraday noise. And to know if a zone is actually strong, count the touches. We're looking for 3 or more to confirm it's a major level. Finally, keep an eye out for violent price rejections. You don't want sluggish chop, you want a sharp, aggressive bounce. That tells you institutional money is actively defending that exact spot.
And inside these zones, we see something super fascinating called role reversal. Basically, a broken support level flips to become new resistance, or broken resistance turns into new support. It signals a massive shift in market psychology. Think about it like this. An asset finally smashes through a stubborn $100 ceiling. The short sellers are trapped, and the buyers who missed the boat are kicking themselves, just waiting for a dip. So when the price eventually pulls back to $100, they absolutely flood the market, turning that old ceiling into a rock-solid brand new floor.
Once your zones are mapped out, you start looking for the footprints of momentum, which are your chart patterns. You've got continuation setups like flags and pennants, showing the market is just catching its breath before pushing further in the same direction. Then you've got reversal setups. Think of a giant W-shaped double bottom bouncing right off a major support level. These aren't just random squiggles on a screen. They are visually telling you the active, real-time story of the market.
Which leads us to Section 4, Candlesticks and Confirmation, the triggers.
Okay, so we have our zones, we see our patterns forming, now we need precision timing. The beautiful thing here is that you absolutely do not need to memorize a textbook full of 50 different obscure candlestick shapes. Mastering just 3 high-impact triggers at key zones will dramatically improve your win rate. First, pin bars. These have those long wicks or tails that scream sharp rejection by buyers or sellers. Second, engulfing candles, where a huge body completely swallows the previous candle, signaling a massive momentum shift. And third, dojis, those tiny little bodies that show pure indecision and exhaustion at the end of a long trend. But hey, context is literally everything here. A pin bar in the middle of a choppy range? Totally meaningless. A pin bar slapping right into a major support zone? Now that is your trigger to act.
Let's put this into a step-by-step blueprint. Step 1, you spot a clear downtrend on, say, the Euro USD 4-hour chart. Step 2, you mark your major daily support zone, let's call it 1.0500. Step 3, you just wait patiently for the price to hit that zone and print a bullish pin bar. Step 4, you plan your entry right above that pin bar's high and tuck your stop right below its low. And while this specific setup shows Forex, imagine executing this exact pure price action trade on Bitcoin, just waiting for that violent pin bar rejection at a massive historical liquidity area before stepping in, totally stress-free and unbothered by lagging indicators.
All right, Section 5, Risk Management Rules, the Shield.
Look, even the absolute sharpest entries can lead to a blown account if you ignore the unglamorous but vital shield of risk management. When you're trading naked, the crucial thing is how you place your stop losses. You have to place them based on market structure, not some arbitrary percentage you pulled out of thin air. Your stop sits right below that structural support, or just under the tail of your reversal candle. Basically, you put it in the exact spot where your entire trade idea is definitively proven wrong. Let the market itself tell you when it's time to get out.
And to survive the inevitable losing streaks, the golden rule is risking only 1% to 2% of your total capital per trade. Let's do the math real quick. A trader with a $10,000 account risking just 1% could literally suffer 10 consecutive losses and still have over $9,000 sitting there ready to fight another day. It is the ultimate tool for capital preservation. Proper position sizing before you enter is just as crucial. If your risk, the distance to your structural stop loss, is say $2, you need your potential reward at the next major zone to be at least $4 or $6. By aiming for a minimum 2-to-1 or even 3-to-1 risk-to-reward ratio, the math completely carries you. Think about it. With a 3-to-1 ratio, you can be right just 25% of the time and still break even. Combine that safety net with high-probability price action setups, and you pave a very clear way to consistent profitability.
Finally, Section 6, the 1-week challenge, test your psychology.
Let's be real, making this switch takes serious psychological discipline. Ditching those indicator crutches requires a massive mindset shift. It takes immense patience and a lot of confidence to just sit on your hands and wait for the market to reveal its true story, rather than acting out of analysis paralysis. You stop reacting and you start anticipating. You move from being a passenger to actually being the pilot. So my final provocative thought for you to take away from this explainer is a challenge. I want you to open up your charts and strip them completely bare. Delete the moving averages, drop the oscillators, focus 100% on pure price action, trend lines, zones, and candles. Could you trade for 1 full week without using any indicators? Give it a try and see if you don't just survive but actually thrive.